Welcome back, guys. Before we proceed into the economic survey details, let us brush up our basics regarding the financial intermediaries. That is, in an economic transaction between two entities, you have the necessity for intermediaries in this complex world. They can be financial institutions like banks or stock exchanges, etc., etc. So we will try to organize and understand the nuances required for our examination. So if you categorize this intermediaries into formal and informal setup, you have under the formal setup the banks and non-banks. So in this video we'll be trying to understand the banking sector as such and all the latest updates and the basics that you require to understand the economic survey and budget issues in the subsequent videos. Before we get into the specifics of the formal financial institutions, let us have a look at the regulator RBI and the brief history behind it. Hilton Young Commission or the Royal Commission on Indian Currency is responsible for the creation of Reserve Bank of India. And you have to remember another important fact that Dr. B.R. Ambedkar submitted his thesis and his economic suggestions to this commission, and that white document is called the Problem of Rupee. In 1934, the RBI Act was created, and in 1948, the shares of the private shareholders were transferred back to the government through the Transfer of Ownership Act, and in 1949 you have the Banking Regulation Act. So these are the chronological events that could be a possible prelims question. Now, coming back to this financial intermediaries and formal institutions, you have banks and non-banks. So within banks, you have the commercial and cooperative banks. Now let us focus on the commercial banks. If we have to classify the commercial banks on the basis of the recognition under the RBI Act, they can be called as scheduled banks or non-scheduled banks. So there is something called Schedule 2 within the RBI Act, which lays down the criteria to be called a scheduled bank. Firstly, the capital should be a minimum of 5 lakhs. And secondly, in the opinion of RBI, the bank is running a business which is safe for the depositor. If these two criteria are fulfilled, it is called a scheduled bank. Otherwise, it is not called a scheduled commercial bank. Now, when the name itself indicates that it is a commercial bank, it is oriented towards making some profit. Another way to classify this is public sector banks, private banks, foreign banks, and differential banks. Let us have a look at each of them. As the name itself indicates, the public sector banks are government owned. So you have the Ministry of Finance. With under the Ministry of Finance, you have the Department of Financial Services, and one of the mandate is banking services. So to fulfill that mandate, public sector banks are established by the government of India. How many public sector banks are there? At the present moment, we have 12 banks. It is not important to remember the details of those banks. But the topic of public sector banks and banking consolidation is important, and we'll be discussing that. Before discussing about the commercial banks, a few trivial points which can be important for prelims examination. The first bank in our country is the Bank of Hindustan. This is not owned by Indians. It is actually a European bank, even though the name indicates that it is an Indian bank. So this was first established in 1770. And after that, in the first half of the 19th century, we have the presidency banks at Bengal, Bombay, Madras, which were later given the power to issue their own currency. In the year 1921, these three banks were merged and led to the formation of Imperial Bank of India, which again was renamed as the State Bank of India in 1955. So it is important to remember the chronology of these trivial points because previous year questions were asked from these areas. Another important point, first major Indian owned bank is the Punjab National Bank in 1894, and who helped in the formation of this bank? Lala Lajpat Rai. So in 1940s, a lot of banks, which we know today as the associated banks of SBI, like State Bank of Mysore, State Bank of Hyderabad, Travancore, etc., were created in the 1940s. Just remember this roughly to arrange questions if there is a possible chronological question. So that is why I'm giving this information. Moving on. The Economic Survey 2020 talked about the 50th anniversary of the nationalization of banks. So in 1969, all the banks which were considered to be private were actually nationalized or taken over by the government through the Banking Companies Ordinance in 1969. So you have to note one important point here. When we say nationalization of banks, it is not all the banks that were nationalized. Only those banks which have deposits worth more than 50 crores were nationalized. So there were some smaller private banks like the Catholic Syrian Bank, for example, they were not nationalized. So if a statement in prelims examination states that all the banks in India were nationalized in 1969, it is false. Please remember this. The reason for bringing up this topic is because the economic survey a couple of years ago brought out the detailed analysis of the evaluation of this step taken by the government 50 years ago. Now, what is the implication of this government control or government shareholding? Firstly, these banks are subjected to Right to Information Act, and if an RTI is filed, they are obliged to give reply to that. Secondly, they are subject to the control of CBI and CVC, and there is strict audit. There is also media presence, and that is why if more scams happen, the public banks are under a larger scrutiny. Third, the board of directors actually, historically, if you take a look at the appointments, government control was very high and it led to a lot of corruption in the banking system. So, keeping this in mind, in 2014, the PJ Committee for Banking Reform suggested that we create a banking investment company, which is a sort of a parent company, and it suggested that the PSB shares, that is the public sector banks shares, should be transferred to this banking investment company, which will take the accountability of banking industry as such. So the next topic that is important in this case is the merger or privatization of banks. Usually when banks non-performing assets, that is the return on the loans or the assets that they have is very bad, the capital gets eroded. As a result, the capital needs of the banks increase, and in order to address this, a lot of banks will be privatized or they will be merged together. Otherwise, what step the government should take is infuse capital into the banking system, which is considered a moral hazard because they are using tax money of the taxpayers to recapitalize the banks for a bad decision taken by the public sector entity. Let's say, for example, the famous cases of either Vijay Mallya or the bad decisions taken in the case of Nirav Modi. So the major accusation was that public sector banks have lent very recklessly. So if government is actually using tax money to recapitalize the banks to make them functioning again, it is considered to be a moral hazard. For addressing this specific issue, the banking investment company is one measure which is proposed by the 2014 PJ Nayak committee. After the LPG reforms in 1991, M. Narasimhan Committee was formed, and that committee recommended that we open up the banking sector again for privatization. So, private banks also started coming into the Indian economy. 1993 is the year we saw the entry of ICICI as well as HDFC, which are the biggest private banks in our country today. Previously, there was a period of window where private banks can come up and apply for a license, but from 2016, the on tap, that is whenever a company decides that they can fulfill the requirements of the criteria laid down by RBI, they can approach RBI and then open up a private bank. So there are certain criteria which RBI now decides from 2016 to start a bank. So when private players want to enter into banking sector, one of the major criteria is the capital requirement is 500 crores according to RBI's notification. And one of the controversy that uh, was in news recently is, can large corporates, let's say for example Tata Sons or Reliance, can they enter into banking industry? There is a moral hazard. What if these banks with such huge capital requirements, they obviously meet that kind of capital requirement, but what if they indulge in lending to their own companies using public's money? Isn't it a very risky proposition? Let's say this very corporate has lent this money to its sister concern or affiliated companies, and the risk is very high. So what happens in such a scenario? The banking system might collapse. So the on tap banking license that was opened up in 2021 by the Shamala Gopinath Committee, which actually accepts or, in fact, examines or reviews the applications for opening up private banks. When this discussion was happening in 2021, one of the paper that was discussed by RBI was whether large corporates should also be allowed to participate in banking industry, maybe come up with better regulations to reduce this risk. So just understand what is the process of opening a bank. Let's say a company is interested in setting up a bank. So first of all, they have to register themselves as a company in the Ministry of Corporate Affairs through Companies Act. Then, as per the latest norms of RBI, 500 crores capital should be mobilized, and if the company wants to go public, SEBI's permission should be taken. Once these two steps are done, they can apply for a license. And let's say, for example, in 2021, if they did apply, Shamala Gopinath Committee will examine whether it is a feasible company or not, and then they give a license. So when they get a license, they do not become directly a scheduled bank. They have the status of non-scheduled bank status. Then after few months, upon observation, when RBI feels that the banking operations that this company is taking up are not shady and they are indeed in public interest, then this non-scheduled bank will be moved to scheduled bank status. So another piece of information that you have to remember is you have PK Mohanty Committee. This is the committee which actually recommended that we allow even the non-banking financial companies and large corporates to set up banks and come up with better regulation instead of completely blocking the possibility of bringing in more efficiency in banking system, because private banks will obviously function in a very competitive manner. So financial industry as such will grow in the economy. This is the argument which was put forward by the PK Mohanty Committee. But the downside, again, we have discussed, is it is too risky, and the amount of financial scams that we have seen in our economy is a precursor to this risk factor that was expressed by the critics of this PK Mohanty Committee recommendation. The next kind of bank that we're talking about is a foreign bank. Now, previously we have discussed that for a bank to be differentiated as a foreign bank or a private bank, the main factor is the place where it was incorporated. Now, in a private bank, the first step is they should register themselves in the Ministry of Corporate Affairs as an Indian bank. Here is the difference. Foreign banks do not register in India, they just open a branch office in India. Their headquarters is somewhere else in a foreign country. So, however, if they have to be running their business in this country, they still have to abide by the regulatory functions uh, that they're supposed to comply with. These orders like CRR, SLR are issued by RBI. However, there is another concept called priority sector lending. I've made a separate video of what this priority sector lending is last year. So that video is still relevant. I will be posting the link in the description box below. So please go through that. Now, if you don't have the time, let me explain briefly. Let's say you have 100 rupees in an economy, and there are two people, A and B, uh, are willing to get access to this credit. We have already discussed how access to credit is very important for financial inclusion. Now, let's say a big corporate takes away 99 rupees as a loan, and just generates around 100 rupees for himself. Let's say the other person B just gets 1 rupee, and he uses that 1 rupee to generate at least 20 paisa of return over this 1 rupee through his economic activity. Now, it is generally important to ensure that this 100 rupees is available to as many people as possible for inclusive growth. This is the idea of financial inclusion. Now, in order to facilitate that, we have the priority sector lending, where this 100 rupees is redistributed to various groups according to the notifications of RBI from time to time. What are those categories? Everything else is discussed in the video below. Please go through that video. You will get a detailed description of what priority sector lending is all about. Now, the next kind of banks that we have in our economy are differential banks. So, the objective of banking is financial inclusion. We have already discussed this. Despite the fact that we have all the banks that we have discussed prior to this, in certain rural areas, we still do not have certain commercial banks presence because uh, it is not feasible for such big banks to operate in a very remote location. For this very purpose, we have another category of banks called differential banks, where they essentially carry out banking activity, but the purpose and scope is very limited. Now, what is this limitation? This limitation can be that they're just confined to a small geography. For example, you have something called the regional rural banks or the local area banks, or they can also be restricted in the scope of their economic activity. Let's say, for example, payment banks. These payment banks, like say, for example, Paytm, have very limited functions. We will discuss this elaborately. Now, let us come back to this RRBs and LAB. What exactly are these? So, regional rural banks were based on the Narasimhan Committee recommendation, and they started in 1970s to achieve the objective of financial inclusion. So these RRBs are financial institutions which are primarily started to ensure that there is adequate credit for agriculture and other rural sectors. So the name itself indicates regional rural bank. Since the objective of RRBs is to reduce the outflow of rural funds, that is, if certain people in rural areas wants to use banking facilities, they should not go to a town or a urban center and deposit money there. But at the same time, banks like SBI or let's say any private bank would not be willing to start a branch because it is not economically viable in a village. So, keeping this practical reality in mind, the experience of the existing banks is taken, and the center as well as state together they came forward to create this RRB structure. So what happens is there is a sponsor bank which invests 35% of its capital, and 50% of the capital is actually given by the center and states give 15%. So in this way, dividing the responsibility between various stakeholders, RRBs were started, and since the purpose itself is to ensure regional balance, the priority sector lending norms is as high as 75%. Please remember this. They have exceptionally high priority sector lending because the very purpose of differential banks is to ensure financial inclusion. The next category of the differential banks that we will be discussing are the small finance banks and the payment banks. Now, these kind of banks have a different purpose. Small finance banks are especially very relevant in small tier 3 and tier 4 towns or suburban areas where they'll be supporting a lot of MSMEs and small businesses or even kirana shops. But there is one caveat here. According to RBI's regulations, joint venture by different promoters is not allowed. Let's say if a small non-banking financial corporation uh, wants to join with another promoter group, let's say a company that is famous for its gold mortgage and lending business. So such kind of joint ventures are not allowed because it is against consumer interest or depositors interest according to RBI. Now, when we're talking about payment banks, this is even before the revolution of UPI came into the Indian economy. We have had various apps like Paytm, etc., which were actually making the remittances very easy. Imagine the problem of migrant workers if they have to send money to their hometown. So this idea was actually very relevant in the continent of Africa, a lot of African nations adopted this payment banking method. So this model, when it clicked in Africa, where mobile phones were used to send money to the hometown, and a charge was taken by the mobile operator, this became a model for a lot of telecom companies in Africa. So looking at that success, a lot of apps like Paytm also ventured into India. Now, this is even before UPI became a huge thing. After Paytm, Airtel, etc., a lot of companies which penetrated into the rural markets, RBI saw that UPI has a lot of scope, and these apps were actually used because of their existing network to convert them into payment banks and in- increase the financial inclusion aspect. So this is the background of payment banks. However, the main point that you have to remember is that they cannot lend, they cannot issue credit cards. Even if you take a look at Paytm credit card, it is not actually Paytm that is directly giving, it is just acting as an agent. There is a bank which is behind this Paytm credit card. That bank is actually taking this credit risk, not the payment bank. Let us have a look at some important points to note about payment banks. So, first of all, we discussed that payment banks will not have credit risk. Now, when you say that there is no credit risk, there will be some follow up questions. So, a normal aspirant might ask, is there any priority sector lending norms which is applicable to the payment bank sector? When I say there is no credit risk, it means that these banks are not allowed to give loans. Then when there are no loans given, where is the question of priority sector lending? There is no lending at all. Forget about priority. So obviously there is no PSL. Then how will they make money? So they will earn interest by making all the deposits in government securities and T-bills. It's a very safe investment because we are talking about very vulnerable sections of the society, and a guaranteed interest will be ensured this way. Can NRIs deposit in this payment banks? Obviously, NRIs have a lot of banking avenues. Why would they want to use a payment bank for remittances, etc.? So it's not for NRIs; it's for the domestic population, small businesses, and MSMEs and migrant workers. So that is the target group, and it is exactly for this reason the maximum deposit allowed in the payment banks has been 1 lakh only. Recently, the limit was raised to 2 lakhs in 2021. Can a payment bank issue a debit card? Obviously, yes, it can issue a debit card because it is not giving any loans out there. Credit cards are not allowed. As you can see in this, the Paytm First credit card is actually powered by Citibank. It is just acting as an agent because of the existing network it has in tier 2 and tier 3 cities. So we have discussed about the commercial banks, the kinds of commercial banks, and now we'll be moving over to the cooperative banks. The next topic that we have to deal with is cooperative banks. Now, before proceeding further, let me bring to your notice a statement that is given by RBI. RBI said that cooperative societies are not banks. Why did RBI say so? What is the idea of cooperatives? Let us understand. In order to run an economic activity, an organization of people is required. Usually, when you take a legal route, people who invest in a business either get into a partnership or go solo with proprietary ownership or proprietary firms or create joint stock companies. But when it comes to the poor, they do not have that kind of money. So, in order to counter this problem, the principle of cooperation was always suggested, and this was suggested even by Mahatma Gandhi as well. Naturally, when you mean cooperation, it is based on the principles of mutual help, democratic participation, and open membership. Now, what do you mean by democratic participation? In a cooperative society or an organization based on cooperation, the membership is open for everyone and every member gets equal vote. If you extend this idea to the banking sector, it is nothing but cooperative banking. Some trivial information which can be used in prelims. Anyonya Sahakari Mandal. This is the first uh, cooperative society which was established way back in 1889 itself under the leadership of a person called Vittal Lakshman. So this was in the princely state of Baroda. And in 1915, a British committee called the Mclagan Committee was studying the measures that were needed to require the strengthening of cooperative banks. And in 1919, under the Government of India Act, the subject of cooperation, the idea of cooperation and its regulation was actually transferred to the provinces from the center. This is important because in July 2021, the Ministry of Cooperation was created. Before that, the Ministry of Agriculture was handling everything that is related to the concept of cooperatives. This is the brief history. Now, here is the caveat. When we are talking about the idea of cooperation, this is actually a state subject. Now, why is the center regulating this is a criticism. It is criticized that this measure is against the spirit of federalism. And when we are talking about banking as a concept, it is under the union list. So Parliament has the power to legislate over the banking industry in our country. So this brings us to the point of cooperative banking regulation. Now, is it the state government that is supposed to regulate this, or is it the Parliament because banking is under union list? So this leads to a very important question about the dual regulation that is associated with the cooperative banking system. Before we talk about that, let us understand the structure of cooperative banks in our country. Based on the geography that they are working in, they are either termed as urban or rural. Again, depending on the tenure of the credit, they can be called short term or long term credit giving institutions. When it comes to short term, there are state cooperative banks, district central cooperative banks, primary agricultural credit societies, and when it comes to long term, you have the state cooperative agriculture and rural development banks and primary cooperative agriculture and rural development banks. But when we're talking about the urban cooperative banks, they can either be scheduled or non-scheduled. Scheduled as in the Schedule 2 of RBI Act, which we have discussed before. And depending on the number of customers they have, they can operate in multiple states or they can operate in a single state. Similarly is the case with non-scheduled urban cooperative banks as well. They can operate in multiple states or in a single state. Please make a note that the primary agricultural credit societies are out of the ambit of RBI and are completely under the state government's control. Please remember this point. So when we're talking about the regulation of cooperative banks, two different functions are visible. On one hand, we have the banking where RBI is regulating, and on the other end, we have the day-to-day administrative functions based on the principle of cooperation. So the registration, the bylaws which regulate the functioning of these cooperative societies, what are the rights of the members, the elections to the managing committee, and the methodology, everything is decided by the state governments under state laws. So this is the dual regulation associated with the idea of cooperative banking. Conceptually speaking, this idea of banking is for its own members and not for people outside. Profit is not the incentive, therefore interest rates are pretty low. But the problem is politicization of these cooperative societies, issue of casteism, non-performing assets, poor recovery of loans, scams, etc. These are commonly associated with cooperative banking system. Cooperative banks can function in multiple states and in a single state. If it is functioning in a single state, that state government will actually regulate it under the Register for Cooperative Societies. At the central level, we have the Multiple State or Multi-State Cooperative Societies Act of 2002. So previously, under the Agricultural Ministry, there was an office, Registrar for Multiple State Cooperative Societies or Multi-State Cooperative Societies. Now that is transferred to the Cooperation Ministry after the formation of this ministry. There is an issue with this dual regulation. For example, let us consider there is a scam in one such urban cooperative bank, which is usually a multi-state entity. So the problem is, whenever there is one such scam, RBI can only limit the transactions happening within that bank for a time being. But if it has to go down to the root of the problem, and sometimes suggest either liquidation or closing down of that bank or merging it with another bank, it will require the approval of that particular state's consent, or let's say here in the case of a multi-state bank, it requires center's approval. There is a delay in this entire game. So one of the committee of RBI suggested that UCBs, or the urban cooperative banks, should upgrade themselves into small finance banks so that RBI can directly regulate, bypassing this regulation. Now, it is important to remember that we discussed that cooperative banks is only meant for members, but when we are talking about urban cooperative banks, it even lends to people beyond their members. Something similar happened in the case of PMC Bank, that is Punjab and Maharashtra Cooperative Bank. It is a multi state scheduled bank, and it used its depositors' money to lend to a different company, which later became non performing asset or a bad loan. Let us look into the details. So, this PMC Bank issue was a huge thing because of the fraud that happened in this bank, where 6,500 crores of 44 accounts was actually transferred to many dummy accounts, and all this is done to one company alone, that is HDIL. So this hidden loan to HDIL has actually become a very big issue, because the failure of this company meant that the actual NPA is almost 77%, whereas the bank showed only 2.19% as non-performing assets. So this huge scam has led RBI to impose restrictions on the transactions of the members. But RBI wanted to not just handle the situation, but completely regulate the bank's functioning. But for this, it required approval from the Register of Credit Societies. So this regulation became a huge issue back then. So government decided that RBI's power should be increased. So in order to increase RBI's powers over the urban cooperative banks, a Banking Regulation Act amendment was brought out. Let us have a look at it. So in June 2020, the Banking Regulation Act was amended and gave RBI the power to become the sole regulatory authority for urban cooperative banks. And within the ambit of this amendment, there are certain conditions which are cleared. Firstly, whenever RBI feels that the actions of the cooperative bank, urban cooperative bank, are against public interest, like in the case of PMC Bank, then it can intervene and remove the board of directors and ensure control for up to 5 years, so that it is in the public interest. Previously, it was supposed to take the permission of the registrar of credit societies. Now that is removed. Another important provision is that the act now gives the freedom for operation to cooperative banks. They can either open a new branch, or if they have an existing branch in a place where they feel it is not viable for them to operate and they want to change. Previously, RBI's permission was mandatory. Now it is not mandatory. That is a point you have to remember. Apart from this, there is another important point. So this long-term credit institutions, as well as the PACS, these are not regulated by RBI. Now this Banking Regulation Act Amendment of 2020 is not applicable to this PACS as well as long-term credit institutions also. And this is the screenshot of the news where RBI said that the word bank should not be used by these primary agricultural credit societies and this long-term credit societies or credit giving institutions. Thus, in this video, we discussed about the formal financial intermediaries, that is banks, both commercial and cooperatives. In the next video, we'll be looking at the non-banking sector or the non-banking financial intermediaries. What are the development finance corporations that were set up recently, and the latest updates. So that's it for now. Keep following this channel. Please like, share, and subscribe if you find some value in this work. That's it for now. Thank you.